Should I be refinancing with these historically low mortgage rates? Today we're talking about these rates and what they mean for both buyers and for homeowners, so stay tuned. Hey guys, Rachel Capil, real estate agent with Keller Williams in the East Bay. If this is your first time to the channel, welcome. We talk about all things Bay Area related, real estate, living here, working, and playing. So if you haven't subscribed, subscribe, click that link below, and get notified every time we have a new video that comes out each week. Okay, so let's jump into today's video. Should I be refinancing is the question here, people. We're talking about these low mortgage rates and what that means to both buyers and to homeowners. So let's get to it. So in July, the 30-year mortgage rates fell to 3%, below 3%. That's crazy, historically low rates, people. I mean, this is a big deal. Some are thinking this is hype. Some are thinking it's not. What do I do? Is the question. Okay, so average mortgage rates have drifted between 4 and 5% in the recent years. They haven't always been so low. Freddie Mac began tracking 30-year mortgage rates in 1971, and at that national average, it was about 7.31. And as inflation started to rise in the mid-70s, mortgage rates surged. So it's hard to believe now, but mortgage rates actually reached a high of 18.63 in 1981. Crazy. Fortunately for home buyers, inflation normalized around October of 1982, which sent mortgage rates downward to about 3.31, was as low as it got in 2012. Since 2012, 30-year fixed rates have risen modestly, with a daily average climbing as high as 4.94 in 2018. So the question is, what's causing these rates to sink so low? I mean, this is like history, people. Well, the answer is just economic uncertainty. That's straight up what it is. So mortgage rates generally follow bond yields because the majority of US mortgages are packaged together and sold as bonds. As the coronavirus pandemic continues to dampen the economy and inject volatility into the market, a growing number of investors are shifting their money into low-risk bonds. Increased demand has driven bond yields and mortgage rates down. However, according to the National Association of Realtors chief economist Lawrence Yun, the number one driver of low mortgage rates is the accommodating Federal Reserve stance to keep interest rates low and buy up mortgage-backed securities. According to Yun, you'll see mortgage rates stay near this level for the next 18 months because of the significance of the Fed's stance. Okay, so how do these low mortgage rates benefit the current homeowner? So low mortgage rates increase buyer demand, which is awesome for sellers. But what if you're not selling your house? Can a current homeowner benefit from these mortgage rates? Yes, they can. And what they can do is they can refinance. So refinancing has just gone through the roof because people want to get a lower rate. If you're in a 4% interest rate and you can get down to a 2.8 or 2.9% interest rate, you can save a boatload of money each month. Take a look at this chart below. It's going to go over monthly costs and how much you can save per month and over the life of the loan. Pretty amazing. Be sure to factor in any prepayment penalties on your current mortgage and closing costs for the new mortgage. For a refinance, expect to pay 2 to 5% of the loan amount. You can divide your closing costs by monthly savings and find out how long it'll take to recoup your investment. A more precise calculation of your potential savings, I'd be happy to connect you with one of our mortgage professionals in our network who can help you decide if refinancing is actually a good option for you. So now the question, how do these low mortgage rates benefit current home buyers? All right, so we've already shown you how low rates can save you money on your mortgage payments, but they can also give a boost to your budget by increasing your purchasing power as a home buyer. For example, imagine if you had a budget of $1,500 to put towards your monthly mortgage payment. If you take out a 30-year mortgage at 5%, you could afford a loan of $279. Now let's assume the mortgage rate falls to 4%. At that rate, you could afford to borrow $314,000 while still keeping the same $1,500 monthly payment. That's a budget increase of $35,000. If the rate falls further to 3%, you could afford to borrow $355,000 and still pay the same $1,500 a month. That's $76,000 over your original budget, all because of the interest rates that fell by 2 percentage points. If you've been priced out of the market before today's low rates, you may be able to put yourself in a better position to afford your dream home by refinancing or utilizing these new rates. So with all that being said, rising mortgage rates could affect and erode your purchasing power. So I would definitely take advantage of these rates today. Get into a good home. If not, as they go up, you're going to have less purchasing power and you may have to settle for a less desirable neighborhood or a smaller home. So act fast if you can and take advantage of these rates now. How low could rates actually go? Well, no one can actually say how low they can go because we don't have a crystal ball. A lot's going to depend on the trajectory of this coronavirus and the economic forecast and what impact that's going to have on our economy. Forecasters at Freddie Mac and Mortgage Bankers Association predict 30-year mortgage rates will have an average 3.2 and 3.5 respectively in 2021. However, economists at Fannie Mae expect them to dip even lower to an average of 2.8 next year. 2.8. That is crazy low. Do not wait. If you have the capability of doing this, you need to consider it and think about it in the next couple months. I would say we have until end of 2020 before we're going to start to see some changes. Many experts agree that those who wait to take advantage of these unprecedented rates could miss out on a deal of a lifetime. With rates now at all-time historic lows, it's hard to imagine that people may be holding out for something even better, warns Paul Begg, President and COO of Atlanta Mortgage. Positive news about a vaccination or faster than expected economic recovery could send rates right back up to pre-pandemic levels. So how can I secure the best available mortgage rate? For one, you can consider doing a 15-year mortgage rate because 30-year mortgage rates are hovering around 3%. So 15-year would be a better rate. By opting for a 15-year mortgage, if you can afford a higher rate monthly payment, a shorter mortgage term can save you a bundle in interest and you'll pay off your home in half the time. So step number one, consider a 15-year mortgage term. Step number two, boost that credit score. The economic downturn has made lenders more cautious these days, but you'll probably need a credit score of at least 740 to secure the lowest rate. There is no fast fix for bad credit, so here are some steps you can take to boost your credit before you apply for that loan. You can dispute any inaccuracies on your credit report. Make sure to pay your bills on time. And if you've missed any payments, make sure to catch those up. Hold off on applying for any new credit cards during this time. Pay off any debt that you can. And if you can't, try to keep those balances low on the credit card and just keep credit cards with a zero balance or a minimal balance, but do not close all your credit cards. Those things will all help you get better credit scores. Another thing you can do is make a large down payment if you're buying a home to get that rate down. A large down payment is really good on a house because you just look less risky to a bank. The more equity you have in a home, the less likely you are to default on your mortgage. That's why lenders offer better rates to borrowers who have sizable down payments. Plus, if you put a down payment of at least 20%, you can avoid paying that PMI mortgage insurance, which is a huge discount. Another tip to get that rate down is to pay for points. Now, discount points are fees paid to the mortgage company in exchange for a lower interest rate. At a cost of 1% of the loan, they aren't cheap, obviously, but the investment can pay off over the long term in interest and savings. One last tip is you can shop around for different mortgage rates. Go to banks, go to different lenders and see which ones have the best rates. Just make sure to do it within 45 days because if they're pulling your credit, you want to make sure that you don't have anything after that and you can find the best rate within 45 days. I personally would rather go to a mortgage broker just because I've tried shopping rates at banks and it is tedious and it's hard work. And sometimes it's just easier to pay someone to search for it. So we're happy to help you with that, but that is the last tip to get that rate down is just shop around. Okay, so there you have it, a ton of information for you to decide if you can take advantage of these historically low mortgage rates and start making money and putting it into your pocket. I hope it was helpful, and we have a ton of really great mortgage professionals that we can help you. If you need an introduction, just DM me, email me, whatever you feel comfortable with, and I'd be happy to connect you, help you save some money and make that bank account bigger. In the meantime, thanks so much for watching and taking the time. I hoped I provided some great value for you, and I look forward to seeing you in the next video. Thanks again. Bye.